Hello, good evening, all of you. Let's get started with our work for today. Uh, I hope that you had some time to go through this question paper. Yesterday, we could not do as much because we were seeing the paper for the first time. But this time around, you've seen the paper, so now I'm sure we can discuss. And also, we told you that within the same questions, there are also solutions. So as you go through them, you also look at the examiner's solutions. So that's what we arrived at yesterday. So let's run through our work, people. Let's run through our work. Question number one, it's a 40-mark question. A 40-mark question. And the question had a number of items. It had the weighted average cost of capital, 8 marks. Evaluate whether T company should close the factory immediately or continue until the end of the lease period using NPV technique. You should state the reason for including each relevant cash flow in evaluation. So this was quite a heavy question because most of it really was on the concept of relevant costing. So this question, the thrust was in the concept of relevant costing. So that's where the thrust was. Okay. Discuss the validity of the observation made by the marketing director in relation to the financial gearing. 11 marks. Now, if you pay attention, you notice that these two are very important. 11 plus 18 gives us 19. So if you do well in these two parts, then you got 19. Here, we do some basic computation to get marks here and there. So you do a basic computation to get some marks here and there. That's what you do. So you need a good exam technique. This question, this part of the question was quite involving. If you spend all your time here, then that's a poor exam technique. That's a very, very poor exam technique because you will not pass the paper. So you look at that one, you say this one seems some is okay, that one sounds okay. And here you do some basic work and then you move on. So don't spend more than the necessary amount of time here. So let's discuss this marketing director. What did he say? Tiger is a manufacturing company that has recorded a high historic PE. So they have recorded a high historical PE, which marketing director has attributed probably to high gearing. High gearing. So the marketing director says the high PE is caused by the high gearing. Tiger manufactures different class of clothing from the factories spread across the country. However, directors of Tiger are considering closing one of the business factories located in the southern part of the country where there is high unemployment. This is due to reduction in demand for a type of clothes made at the factory in question in recent years. So then let's discuss this first bit. The marketing director says the high PE was due to high gearing. So how would you answer this question? How would you answer this question in the exam? What do you think is the best approach to answering this particular question? To answer a question like that, here's what one approach you would use. One, you tell us what PE is. Share price over EPS. So that's what you must do. Start off by first explaining what is PE. So you tell us this is how to calculate PE. Next, talk about the PE. What does the PE tell us? You must indicate that the PE tells us about the future prospects of the company. Tell us about the future prospects of the company. That's the second point that you tell us. So then, what would make a company have a high PE? So if a company has a high PE, what does it mean? It means that it's got a better future prospects. That's what it means. They're enjoying high investor confidence because of the bright future. Because of the bright future. So they are good. So which companies are likely to have a high PE? Which companies are likely to have high PE? Those companies which are well managed. Those companies that are considered to be low risk. And that those companies that are listed on the stock exchange. So you indicate if you have a well managed company, if you've got a company with low levels of risk, if you've got a company which is listed, these will lead to high PE. So that's what you're going to say in the explanation. On the other hand, what does high gearing mean? This is a company that has got a high component of debt in the capital structure, high debt component. Such a company is considered to be a high risk company. Why? Because their earnings are likely to be more volatile. Earnings are expected more volatile. Why? Because of the high interest payable. So when there's a drop in business activity, you find that the earnings also go down. So you have explained what PE is and when is the PE high. You have explained what is high gearing, okay, and also the features of high gearing. So now you conclude. Do you think that high gearing could have caused a high PE? The answer is no. The answer is no. A highly geared company would have a low PE. A highly geared company would have a low PE because the investors are likely to be skeptical about the future of the company. So this is how you would answer such a question. You take the PE, talk about the PE, take high gearing, talk about it, and then you put a conclusion. Okay. All right, team members, we hope you're all happy with that bit. Let's now come to the other bit. You were asked to calculate the weighted average cost of capital. Now, if the question ever says calculate the what, look at how the company has been financed. Financed by who? Let's go. The company is financed by 1,015,000 were ordinary shares. So these are 1 million shares. With an X dividend market value of 15 kwacha each. X div is what we need. And 1.5 million of 10% irredeemable loan inventory with an X interest market value of 1050. Each issued at 1,000. The dividend, which has just been paid, is a constant amount of 3 kwacha. So the company pays a constant dividend. T applies its current cost of capital to investment projects of this nature. All cash flows occur at the end of the relevant period. So team members, the question was, you calculate the cost of an irredeemable bond. You calculate the cost of an irredeemable bond. So do we remember how to find the cost of a bond which is irredeemable? Team members, the bond is irredeemable. How do we find the cost of the bond which is irredeemable? So you say the cost is, you take the interest, 1 minus T, and divide by the market value of the bond. We divide by the market value of the bond times 100. So this is how you find the cost of a bond which is irredeemable. What are the costs of equity? What are you told? The dividend is constant. So if you are dealing with a situation of a constant dividend, this is the formula that we use. Cost of equity is dividend over the share price. Then from there, you get the market values. So this question is good because we rarely get a constant dividend, and we rarely get a bond which is irredeemable. We rarely get a question bonds that are irredeemable. So then this question is good for that purpose. I'm sure team members tried that. Team members tried that. So let's go. Here we are, team members. The interest is 10% on 1,000, that is 100. The X interest market value is 1050. So then your market value of the bond is 100 over 1050 times 100 plus 9.52. So we hope you got that right. Yeah. What of the market value? What of cost of equity? Cost of equity, team members, is here. A constant dividend over share price times 100. So you go 3 over 15 times 100, that is 20. So that's the cost of equity, where the dividend is constant. Is that okay? The dividend was constant here. Then you conclude by market values, get the market values, 1 million shares, each one of them at 15. The date, 1.5 divided by 1,000, the nominal value, multiplied by the market value. So that's the market value there. So the capital structure of this company is 90% equity and 10% debt. So you multiply this way, and you have your 19%. Hopefully you all fared well. Team members, hopefully you all fared well. So the cost of equity, what was the trick? Well, it was a constant dividend. It was a constant dividend. Okay. What over the loan note? It was irredeemable. The loan note was irredeemable. So 19%. Now let's come to this question, which you can call was very complex. What was the best way of handling this investment appraisal question? Here's the approach. The approach would have said, if the factory is run for another 5 years, what are the cash flows? And discount those cash flows. So if you run the project or this factory for another 5 years, there are going to be cash outflows and cash inflows. The biggest trick, probably problem, the question was the profits. You are given accounting profits. If factory continues in operation until end of the lease, the following operating profits are expected. These are operating profits, which you needed to convert to cash flows. How? Information was given. Information was given to enable you to do so. What information was given to enable you to do so? Well, they gave us information about depreciation. So you had to add back depreciation. The annual depreciation for machine and equipment, which has been included in the above figures, is 850. So all we're supposed to do is take these figures and significantly add 850,000. So take each one of these profit figures, add 850,000. To convert these profits into a cash flow. To convert these profits into a cash flow. That's what was expected. I hope you pick that point. So if you had done that, the exam would have been very happy with you. Then there were a number of cash inflows. What were the cash inflows? The residual value of the machine and equipment at the end of the lease is 200,000. So you run it for 5 years, then that's a cash inflow. Edender's payments are expected to be 170 at the end of the lease period. So you run this factory for 5 years, and these are costs, are cash flows for year 5. So just put them there in year 5. Team members, is that okay? Where are the other cash flows? Let's pick the other cash flows. Team members, the other cash flows are all here. The factory is leased and there are 5 years of the lease remaining, so you can run it for another 5 years. And for the next 5 years, capture the inflows and outflows. And we have seen these already, haven't we? The director is uncertain as to whether the factory should be closed immediately or at the end of the period of the lease. The company has offered to sublet the premises from T at the rent of 160 a year for the remainder of the lease. What do you call this? There's a company which says, as we can take over this factory and you pay 160. What does this mean? If you continue running the factory yourself, this becomes an opportunity cost. This becomes an opportunity cost. That's what it becomes. So every year you're losing out this, so you've got a cash outflow. This opportunity cost is a relevant cost. It's a relevant cost. It's an opportunity cost. So it's an outflow. So you capture that as an outflow. Is that okay? The machinery and equipment at the factory cost of 5 million and have a net book value of 550. Those are irrelevant. However, if the factory is closed immediately, machinery and equipment can be sold for scrap of 250. What would you call these people? This is an opportunity cost. We are losing out. If we continue running our factory, this is lost income. So this will come in as a cash outflow. So we've got the cash outflow. The working capital at the factory is 500 and could be liquidated for that amount immediately. So this is another cash outflow, lost income. Have you picked those figures? Mm-hmm. Then we go. Alternatively, the working capital can be liquidated at the end of the lease. Immediate closure would result in redundant payments of 215. So this is a saving. This is a saving. That is a saving because we could have paid this amount of money, but we won't pay, so that's a saving. Otherwise, that's a cash inflow. The working capital at the factory is 500,000 and could be liquidated. So this one also is captured as a cash outflow. So when you look at the question to look complicated, we'll go through the figures. Realistically, you cannot get all the figures correct, realistically, but at least some of those figures will be right. Okay. Are we okay, team members? If we are okay, let's look at the tabulation of the cash flows. So here's our solution. So take the operating cash flows, add back depreciation, add back. So this is the cash flows. Then remember the opportunity cost 160. Remember machine, if we close down, we would have sold the machine for 250, but when you sell it at the end for 200. Working capital, remember, we are losing out, but we're going to recover it at the end. Redundancy cost is a saving. And we are done. Then we discount all these at 19%. Where is 19% coming from? That's the work which we calculated. This was the work that we calculated. We calculated that. That gives us 2815. So the NPV is positive. So what is your conclusion? We must run the factory for the next 5 years. Why? Because the NPV is positive. That figure represents the wealth for our shareholders. So that is the wealth that we are going to create for our shareholders. Team members, have you followed? So this is how the question is to be done. First of all, operating profits, add depreciation, convert the cash flows. After that, there are a number of relevant costs, lost income on rentals, lost income on possible sale of the machine, lost income, possible liquidation of working capital. Then you have got this saving on the redundancy costs. But these figures arise again at the end. Okay, so if you had a challenge, we encourage you to take the question again, go through the cash flows and capture the whole essence of these cash flows. So that was the question there. We have answered all the parts of the question. There's another question here, a bit of strange question, but not very complicated. Evaluate whether B should invest in the machine or invest its money at the rate of 20%. Discuss advantages and disadvantages of retained earnings as a source of finance for the proposed investment. For this part of the question, I propose that you straight away go to the solution presented by the examiner and capture the advantages and disadvantages of retained earnings. So I've checked the examiner solution. It's just okay. I've checked the examiner solution. It's just okay. Only disadvantage, just add one. One disadvantage is the amounts. The amounts are limited. So if you have got a very big project, money coming from the retained earnings may not be adequate to finance a big project. So one disadvantage is the limitation in the amount. It may not be adequate for your project. Okay. Team members, I hope that is okay. So this one captured from the examine. What of the actual question? If you have read through the question, the research shows that the business could provide a standard service that it has developed or invest the money at 20% a year and earn 1.2 million after 5 years. So you can invest your money now, and 5 years, you get 1.2 million. What is the other project? The provision of the service would require investment at 1 million immediately. The scrap value is 200. Sales of the service are here. The selling price is 50. The variable cost is 100. The corporation tax is 30%. The discount rate is 20%. So team members, this is not a very complicated investment appraisal question. I'm sure all of you would agree with me that it wasn't. All we are supposed to do was, for the next 5 years, the selling price was here, the variable case was there, the contribution was there, the number of units was there, total contribution was there, and remove the tax at 30%. So there were no complications. And then you have net flow, the asset is here, and then you discount at 20%. You discount at 20% team members. Discount factors are 20%. So if you discount selling price, less variable cost, contribution, multiply the number of units, total contribution, tax at 30%, net flow, and the asset cash flows, you've got a final net discount at 20%. Okay. So if you discount at 20%, you have 579. So this is the net present value. What of if you invest? If you invest, you're going to get 1.2 in year 5. So 1.2 discounted using the discount factor for year 5 there, you got 482. So you can compare. If you invest 579, if you invest here 4.82. So when you look at the two amounts, you can see that this is better. That's a lot better. Okay. So it's a type of an investment appraisal, but not very complicated. Good team members. So we hope you are happy with that question there. Question number 3. Question number 3, evaluation question. Question number 3 was evaluation. What valuation? The price earnings ratio, dividend growth valuation, and cash flow valuation. So these are the 3 valuation methods. The price earnings ratio method, value of a share is the PE multiplied by the EPS. Value of equity is the PE multiplied by the PAT. So this is the method that we can use. Where does the PE come from? The PE comes from, you borrow it. What of the EPS comes from the company? Dividend growth model, you say the share price equals dividend after 1 year over KE minus G. Cash flow valuation, this is where we discount the cash flows. And one of the aspects we want to emphasize as we go through the questions is this method, the cash flow valuation method, where we simply discount the cash flows attributable to a company. So what you do is you've got operating profit, convert them to cash flows and discount them. And that gives us the value of the company. So as you come across this type of a question, we talk about it so that you are ready for this type of a valuation. Do we have enough information? Yes, we have enough information. Do we have enough information? Yes, we have enough information. They have given us the PE, Bright. So to value Monga, we're going to borrow 12 from Bright. Then we multiply by the EPS of 0.37. Okay. What of the dividend valuation model? Yes, we've got dividends here. So we can get the historic pattern here. What of the cost of equity? We have the cost of equity of 15 here, but they gave us an indication. It estimated that the shareholders of Monga require a rate of return of 20% higher than the shareholders in Bright. So that will enable us to calculate, okay, fine. So we take 15. So the cost of equity for Monga will be 15 multiplied by 1.2. So that's what will give us the cost of equity. Okay. Let's now come to the question here. Let's go through the solution. Let's go through the solution. Let's go through the solution, team members. So we go P evaluation, P evaluation. The earnings multiplied by the PE. So the PE is here, the earnings is there. You multiply these two, you find the share price, multiply by the number of shares, you find the total value of equity. I'm sure all of us should do well. Should we get a question involving the P evaluation? So remember, the value of the share is the EPS multiplied by the PE. EPS comes from the company valued, PE you're going to borrow. Dividend valuation, you need to find the growth. You need to find the growth here. The growth. Team members, what was the annual growth of the dividend? The annual growth of the dividend in year 5, that was 0.23. There, that was 0.15. The growth at second place how many times? 1, 2, 3, 4. So this, the power 1 over 4. Then minus 1 times 100. What is the growth? What is the growth factor there? What's the growth? Somebody give us the growth, please. Team members, have you found the answer? What's the growth factor? 0.23 divided by 0.0. You can even say just 23 divided by 15 to the power 0.25. Then minus 1 times 100. What do you find? What do your numbers show you? What's the growth factor? Okay, we go here. We can benefit from my figures. So if you do everything correct there, you find, okay, 10.6, 10.6. That's what somebody has found there. 10.6. My answer is here. Okay. Let's just check something here. Let's just check the growth. How many times the growth has taken place? Okay. That's 1, 2, 3, 4. So the growth has taken place 4 times. The growth has taken place 4 times. So let's go. Dividend today 0.27. The growth. Okay, let's go. Let's check. Yeah. My growth is 12.47. Please, can you counter check that? 4.47. Can we counter check that? 0.23. Okay, here we are. That's a bit of a correction there. The current dividend, the current is 0.27. Team members, just correct that. The current is 0.27. So here we are supposed to add another year, and this is year 6. Please add this one. The current dividend has been given. The dividend for the past 5 years. This is past 5 years, and the current year is, which is, so it's 0.27. Correct that, team members. So you say 0.27 over 0.15 to the power 1 over 5 minus 1 times 100. Okay, let's go. 4.47, that's okay. All right. So somebody has confirmed there was an error there. They gave a current dividend, so we needed to update our table to put a 0.27 there. Please prove the figures. Use the calculators, prove the figures. Now, if we are okay, so the dividend today is 0.27. So how do you get your share price? How do you get your share price? You get your dividend after 1 year. So you take 0.27 multiplied by the dividend after 1 year, 1.1247. Then you divide by the cost of equity. The cost of equity is 18%. Minus the growth factor, which is 12.47%. Team members, can you please do that? 0.27 multiplied by 1.1247, we are growing by 2.47%. Remember, your formula is the share price, dividend after 1 year, cost of equity minus the growth rate. The cost of equity, you increase it by 20%. That's 18. Let's prove our answers. Let's prove our answers. Take a dividend after 1 year, divide by, then multiply by number of shares. Can you please counter check that? Team members, can you counter check that? Can you counter check this number? You multiply your share, what you get by 5. 0.27 after 1 year divided by the cost of equity minus the growth rate. Then what comes from here, you multiply by the number of shares. What are we getting? What are we getting? Anyone who can confirm? 12.47? Anyone confirm 12.47, 27.46? Okay, I'm sure you have confirmed that figure. Let's move to the next item, cash flow valuation method. Cash flow valuation method. It's estimated that the shareholders of M, well, that one we've dealt with it already. Bright estimated that cash flows at the end of the first year will be 2.5, and these will grow at an annual rate of 5%. Also expects to raise 5 million in 2 years' time by selling off the hotels. So another valuation method, team members, is to take the cash flows for a company and discount them at the weighted average cost of capital. So let's do that. Let's do the valuation. You've got free cash flow. So how do you value? You borrow this formula here. This is the formula that you borrow. So you borrow this formula. Are we together, team members? You borrow this formula. That's what you do. Now, instead of where there's the dividend, you say the cash flow, and we call it a free cash flow after 1 year. Then here, down here, instead of cost of equity, you put whatever cost of capital minus the growth. So, what are we told? We are told that the free cash flow after 1 year is 2.5. So that's what. That has been given. Okay. The weighted average cost of capital is 12%. Okay. Minus the growth is 5%. So you get a value here. You get a value there. What else? There's also, you're going to sell the asset in 2 years' time. So you take the 5 multiplied by the discount factor in year 2. And after that, what happens? You add the two values. Which two values you add? That value plus that value, the money raised from the sale of the asset, and this is at 9.7. So this is another method of valuing company. What do we call this? It's simply discounting of cash flows. Discounting of cash flows. So you just discount the cash flows. And these cash flows, if they are in perpetuity, we borrow this formula here. Now when we borrow it, we say on top, cash flow after 1 year, whatever the cost of capital, and the growth in the cash flows. Team members, is that okay? The information came from here. B estimated that cash flows at the end of the first year will be 2.5. So they've given you a cash flow after 1 year. There's no need of growing this. And these will grow at an annual rate of 5%. So these will be growing forever. B also expects to raise 5 million in 2 years' time by selling off hotels of M that are surplus to its needs. And then the weighted average cost of capital is here. So this is the average cost of capital that we use. The growth was given. The cash flow after 1 year, free cash flow after 1 year was also given. Well, we hope you have captured that valuation there. So if you're in doubt, you take the question and run through it again. Take the question and run through it again. We move to the next question, which was working capital management. Now you may remember that the last question, we did it yesterday. The last question, that one we did yesterday. Sensitivity analysis, that we did. So this is the last question that we are going to look at. So let's take this question, team members. Let's take this question. Now, I hope and trust that you have gone through the question. You have read through the figures, and now we can run through the concept. So the concept was working capital management or cash operating cycle. That's what it was all about. Calculate the working capital cycle of YAM at the end of December 2023. Working capital cycle, do you remember how we calculate it? Yes, we need receivable days. We add inventory days. And we subtract the payable days. So we just start to calculate these ratios. Did we have enough information? Yes. Yes, the information is given here. The inventory is given here. Receivable is given there. Payables are given here. So what was required for you to do well? It was a formula. Formula for inventory days. Now, I don't think that's an issue. Formula for receivable days. Now, I know that we have done more complicated things like this, and also payable days. I know that in class we did much more involving calculations than this. So, credit sales we are given. The credit sales we are 40. The cost of sales was 26. So this information then, with this information then, there was no issues. What do you think? Team members, with this information, do you think there were any issues? I'm sure all of you must have fared very well. I'm sure all of you must have fared very well on this particular question. So let's go. Receivable, average receivable over the credit sales by 365, you get 60. Inventory 57 over the cost of sales by 365. Payable, the average payable days over the cost of sales by 365. So these are the figures. So when you add that, and subtract this one, you get 110. When money goes out of our business, it takes 110 days for it to come back. So you may want to compare this with the industry. Compare this with the industry. What are your friends doing in the industry? Compare that with a trend. the historical pattern. How is the historical pattern? Are you within the pattern or you're off the pattern? Okay, so I hope in this, all of us on working capital, we are prepared for the working capital cycle. Remember, if you are in manufacturing, you break down your inventories to include these elements. Now, you've got recordings on this. You've got questions which you have done, where we illustrated how to calculate this. Huh? Yeah. Uh, let's look at the next part of the question. Explain the implication of positive and negative working capital cycle. So, a positive working capital cycle represents how long it takes for the money to come back. So it means we are waiting. We have to wait for that money to come in. So in our case, it will take 110 days. And normally that's what happens. When we manufacture goods and sell, it takes time. What if it's negative? Negative, it means that if you collect money in advance, you collect your money in advance ahead of ahead of your purchases, ahead of your sales. So it means that this time you're not owing, you are not expecting money. You are the one actually who is owing. They are owing this money. So it's like customers have paid you in advance. And if that's your business, well, that's good. But normally for many businesses, you have to wait. You have to wait. Calculate the quick ratio or acid test ratio, the target, and the target ratio of sales to net working capital as of that date. Now, this one was a bit of a tricky question. So we learned something. What do we learn from this question? They gave us some targets. Inventory 60 days, receivables 25 days, trade payables 55 days. So from this information, we're expected to convert these into receivables, receivable amounts from this data. From this data, we are supposed to come up with a payable amount. From this data, we're supposed to come up with the inventory. So these are the figures that we're supposed to come up with. Okay. Is that okay, people? So how do we come up with these values? How do you convert these to values? You simply say 60 over 365 multiplied by the sales. So let's go. Let's convert this together. So you need the inventory, 6 over 365 multiplied by the cost of sales. The receivables, 5 over 365 multiplied by 40. So this is the inventory. Now some of you are saying, why are we calculating that? We want to calculate the quick ratio. How do you calculate the quick ratio, team members? You get the current assets less inventory over the current liabilities. So now we have your inventory, we have receivables. So the significant thing was to convert this to amounts. Is that okay? Trade payables, you convert as well. Now, there was a little bit of a trick there. Let's pick it up from the question. The current ratio was 1.4. The current ratio was 1.4. What does that mean? It means the current assets to current liabilities was expected to be 1.4. That was the target. So if this figure is known, then you can calculate our current liabilities. If that figure is known, we can calculate our current liabilities. How do we do so? Let's come here. We have calculated the current asset. What of the current liabilities? Can we find it? Yes, you can find it. Because we are saying current assets to current liabilities is 1.4. And current assets, you know it is 12,164. So we do a cross multiplication. 12,164 over the current liabilities we don't know should be 1.4. So when you do a cross multiplication, you work out your current liabilities. Are we together? So here we go. Current assets, current liabilities, 1.4 to 1. 164. So when we work backwards, we do cross multiplication, find 8689. When we do this, you say x equals 12164 over 1.4. So that's your current liabilities. So the current liabilities figure has been found here. This one is already known. So then the balance was only an overdraft because there are only two items here. The sales was trade payables and overdraft. So this one is known, that one is known. So the balancing figure was overdraft. So then the question was saying, can you calculate your target quick ratio? Oh yes, you can calculate it because you have all your answers. So answers are here now. Current assets less inventory. Current assets less inventory. Current liabilities is here. So when you divide this and that, your quick ratio was 0.95. So remember the quick ratio is simply your current assets less the inventory over the current liabilities. So the answer was 0.95. Next, the examiner also wanted you to give something, sales to working capital. So there's no problem. Your sales is 40. Working capital, can pick it. Working capital is simply your current assets less your current liabilities. Current assets, team members, less current liabilities. That gives you the net working capital. So that's what you have. Net working capital. So you come here, sales, working capital. There we are. So what does this mean? What does this mean? This is the sales per $1 invested in the working capital. This is sales per $1 invested in the working capital. So for every $1 invested in working capital, here we are generating sales of so much. their sales of so much. So there's a relationship between your sales and working capital. To generate sales, what do you need? You need to invest in working capital. So the more sales you want, the more working capital you must invest in. How is that? So what was happening? What was a working capital position? The summary. So this is X3. Okay, let's pick the correct notation because we need to write a story here. We need to write a story. So what story are you going to write? Let's look at what the question says. Analyze the current asset and current liability for December 23 and December 24. December 23 and December 24. So December, they're here. So 23 and 24. So we can see what is happening there. We are projecting an increase in receivable days, meaning that you are taking your receivable collection has slowed down. The amounts in inventory investment is expected to go down. But the problem that we have seems to be the payables. The payables are almost doubling. The payables are almost doubling. So we are using the payables to fund our working capital. We're using our payables to fund our working capital. So we need to comment that there is a reduction in activity there in debt collection. Our inventory levels have come down. This is good. But there seems to be a bigger problem there where we're taking too long. We're taking too long to pay our suppliers. So that's the comment that we have. What of funding policy? How was the funding, the working capital financing? Yes. What change has taken place? You look at the current assets and the current liabilities. You look at the current assets and current liabilities. So how do you do that, team members? How do you do that? Or you come here, you say current assets, here's what you do. Current assets down and current liabilities on top. Want to check the funding. So here you go, you say the current asset of 12,164, 8689 is coming from the short term. Are we together? So what we are projecting is this position. 964, that will come from the short term. Let's find the number. Let's find the number. So you go, you say, okay. So you say plus 8689 plus that divided by okay. Go plus that divided by this. So 71%, 71% will come from short-term finance. Some of you are saying, what have we done there? What we have done is we have said, out of so much current assets, how much is coming from current liabilities? So I did 12,164, and the current liabilities is 8689 times 100. So 71% comes from short term. This is what we're projecting. What of currently? Where are we? So you come back here and you check your figures here. Check your figures here. So currently we are at 56%. Now we're getting 71%. So we are moving towards the use of short-term finance. So we are using more and more of short-term finance, the payables. That's what we're using. What do you call this strategy? Could one of you give us the answer? What do we call a financing strategy where a company uses so much short-term finance to finance its working capital? What do we call this strategy? Okay. Somebody has answered aggressive. Well done. So the company is moving from what? From moderate. They're going to aggressive. So this is the change that is taking place here. Okay, team members, so that was our work for today. If you had not found time to do the work, we encourage you to come back and do the work. So we are done with March 25. Next, to prepare for class for tomorrow. Prepare for class for tomorrow. So what do you want you to do tomorrow? We are going to pick the June paper. June 2025. So before class, all of you have got the responsibility to take that paper. Tomorrow is the weekend. Go through the whole paper. Please go through the whole paper tomorrow. And as you go through, you also check your answers. Tomorrow, I want more participation because all of you would have exhausted the paper. So you need to do the whole paper. And when we come here, we again go through together. Like that, you are going to benefit a lot. We'll go through together. But what will make sense is, first of all, you attempt the whole paper. When we come, we run through the paper together. Okay? So, team members, we'll see you tomorrow. And you know our time tomorrow is the 15 hours. We'll see you tomorrow that time.
Thank you.